Hello, and welcome to the Layer 1 podcast. My name is Kelvin Sparks. This is my co-host, Stephen Gates, co-founder of Hypha. Joining us today, we have Nicholas Kunkel, CEO of Chronicle, and Rhett Shipp, founder of Avant. Welcome to the show. How are we all doing?
Doing great, guys.
Yeah, glad to be here.
Before we begin, Layer 1's a podcast focused on the intersection of crypto and the real world, and it's brought to you in collaboration with Avalanche. Nothing we say in this podcast is investment or financial advice. Make sure to always do your own research. In today's episode, we'll be talking about DeFi with two DeFi OGs. That being said, Steven, I know you're a DeFi founder. Do you want to kick us off this one?
Yeah, looking forward to this one. You guys are, I always love talking to entrepreneurs and founders who are at the bleeding edge of what's going on. And I've noticed a theme that DeFi founders, they've always got the most interesting stories on how they got into DeFi and then how they got to where they are today. So curious just to, a bit of a softball, but to tee it off from here, starting with Rhett, like how'd you get into DeFi? How'd you get into Avant? Like what's the story?
Yeah, great question. So before I was in crypto working, I guess, further back history, very brief. I started my career in a kind of a niche area of economics consulting, and then transitioned and worked as a data scientist at a SaaS company for a lot of years. Back when I was doing econ consulting in the early days, some of my coworkers and I would like debate Bitcoin. This was maybe like 2010, 11. I never bought any at the time, but there's a few people there that were kind of like really pro, a few that thought it was the dumbest thing ever. And I was like on the fence. I couldn't really decide how I felt about it. The first time I heard of Ethereum was, it had already gone live, but kind of in that 2016-17 era. And I was immediately sold on that. And so started kind of casually investing and following really closely in the ICO era. What really, the first, I remember before MakerDAO went live, I listened to an interview with Rune talking about the concept, and I was like super captivated by the idea of, this style of synthetic stablecoin. It was unclear to me if it could work, but if it could, it'd be really like amazing. And so was really excited about that concept. And then I, invested in some things and kind of sat on those for a while. And then in 2020, when kind of DeFi summer took off, I just got super obsessed and was using all of the DeFi things and, helping out in some Discord communities, but still employed in a different industry. At one point in 2021, I was basically working a full-time job and then spending 50 hours a week doing DeFi stuff. And the person I was dating at the time was like, why don't you just quit your job and do crypto? And I was like, that seems a little bit foolish. And the next day I had a one-on-one with my boss, and I just like randomly was like, hey, I think I need to leave. And she's like, oh, okay. So I spun down from that job. I loved that job, by the way, and I still love, AI and machine learning. But and then helped out some crypto projects. And then, to wrap it up, I ended up taking a job at a crypto asset manager for a little while. And then saw some things that I felt like needed to be built that weren't being built. At one point, I called up the liquidity team and was like, hey, I think you should build this next. And they're like, well, we're building other things. So ended up kind of just starting to build some things. Didn't really like intend to start anything really, but there was just some stuff that I wanted to use that others weren't building. So, built a CDP and then Avant, which is kind of a yield platform, you could call it.
That's incredible. That might be the first time I've heard of a girlfriend telling their guy to quit their job and get into crypto.
She was very supportive.
Man, that's funny you mentioned MakerDAO, because I think our other guest is very, very familiar with some of the stuff that got you interested in crypto. So, Nicholas, how'd you get into DeFi?
Yeah, so I was at IBM Research for a time and was working on Hyperledger, which was like a permission blockchain. You could call it an institutional blockchain. Very interesting, actually. This was around like 2015. So like IBM was like very, very early, which is not normal for them. They're usually a late mover. I think this was almost like a reaction to having missed the ball on cloud, right? Where the server business was always IBM's like bread and butter, and they just got eaten alive by Azure and AWS. So I think they kind of swore like, okay, the next big thing that comes along, we're going in early, we're going in big. And that was right around the time when the Ethereum white paper came out. And so went to my boss and was like, hey, we're doing this all wrong, right? Like permission chain doesn't matter, it's all going to be about this like public chain called Ethereum, and was, told in no uncertain terms to just like, shut up, get back to work. I think like about like 6 to 8 months later, like Ethereum actually launched, and I went back to my boss and I was like, look, it's not vaporware, it's real. Like, you can do a transaction on it, you can deploy a smart contract, and was again told to shut up. And so I left, and I was pretty convinced I wanted to work on, not on like Ethereum, the chain, but like on the app layer. And then I started looking around. I'm like, there's not really anyone. There were basically 3 projects that I thought were like credible, right? Right, not companies, not nobody had any funding, right? They were just like some people that were like just working on some cool stuff together. And so one of them was MakerDAO. The second was Augur, prediction market. They were right. They were just way too early. The other was Digix, right? Tokenized gold, which if you're, you look at what Tether has done over the past year, right? With that new gold product, right? Again, right product, just timing was way too early. Fortunately, I out of those 3, I chose the one that actually survived. So that was that was my journey into crypto and into DeFi specifically.
And what did that look like, getting involved with Maker at that point in time? Like literally, what did that look like?
There wasn't even an interview process or anything. There was just here's the GitHub repo, like start working on stuff, and eventually it's like, hey, like, do you want to get paid? And like, yeah. Like there was no salary negotiation. Everybody got paid the same amount. There was no like contract that said you were going to get some tokens and this is the amount and this was your vesting schedule. I think just after like a few like months of working there, I just randomly got airdropped a bunch of tokens in my wallet and was like, nobody had even told me anything. They just showed up. It was an interesting time back then.
And so one of the things I was curious about, I'm not sure, I think it was you, Nicholas, you spoke to value accrual. Where do you see the most valuable like layers of crypto currently?
I mean, I think Maker and others have proven that the stablecoin business is enormously profitable, right? It's a great business model. You essentially have zero cost of capital, right? And so other people are letting you earn yield off of their capital. So that's always a great deal. I think lending markets, right, credit markets in general, have performed very well, are going to continue to perform extremely well. I do think they are a bit hamstrung right now because they rely on crypto native collateral, right? So essentially their growth is capped by what is the combined market cap of Bitcoin and ETH, right? And what percentage can be captured of that sum can be captured in your protocol. Tokenized assets, I think, are a way to subvert that, right, and to get access to a huge new pool of quality collateral. That being said, right, we're seeing not all collaterals created equal, right? We are seeing some distortions in private credit right now, that will could potentially have some ripple effects into, the existing tokenized private credit products. But it's the same core business, right? From a lending perspective, right? It's just you're evaluating collateral risk, right, from a variety of areas. But I do think, like, as quickly as tokenized assets are growing, they're not growing quickly enough, right, for those lending protocols to really get that hockey stick growth. But I do think within the next 12 to 24 months, right, we will hit that threshold, that inflection point, right, and then it's off to the races. And then I guess the third one is that came out of left field is Pump.fun. I saw today they still have $500 million of annualized revenue. And that made sense, when all the mania was around meme coins, but they're maintaining that. Who are these people? Who is still in the trenches on Pump.fun? Who has money left to feed this $500 million of annualized revenue? It's pretty crazy, actually.
Yeah, well said. Well said. One of the things that you touched on with respect to stablecoins, and I mean, just the statement in general, I thought was extremely profound and very accurate. I just got off chatting with Galaxy Digital and Superstate. They said the same thing about the growth of DeFi protocols being almost encumbered by the size of Bitcoin and Ethereum, to your point, but that is going to change. One of the things you mentioned was stablecoins. So currently, I believe stablecoins are around 300 billion market cap, give or take. But yield bearing is probably less than 5%, you could safely assume, of that. What's interesting is, Brett, I believe you guys announced that you had raised to build a yield bearing stablecoin protocol in 2024. You were super early. I guess, how'd you have that foresight?
Well, okay. We don't really call it a stablecoin. AVUSD is, we'll call it a dollar-like product. I think there's a more specific definition these days of a stablecoin, which is kind of it's backed by treasuries or bank deposits or whatever. It's funny. I don't know that we were necessarily that early. I think people have been wanting yield-bearing stables forever, and I'm going clear back into DeFi summer era. I would talk a lot about hey, I'd love to see someone decompose Tether, basically Tether competitors that actually give us the yield. And there's some challenges there. There's some workarounds. So a lot of the newer kind of fiat stables do share yield, but they have to be there's some weird rules around how they can do that in a lot of cases. And Tether's business has been so incredible because to Nicholas' point, their cost of capital is basically zero. They can sit on, an incredible amount of treasuries and other yield-bearing assets and pass through none of that yield, but there's giving high utility to people just by giving them access to dollars. And they capture, amazingly high revenues. I think to compete in the future, especially the incoming players that don't already have incredible network effects, have to have some kind of value prop. And passing through yield is one of those. Before Avant, I had worked at this crypto asset manager, and one of the things we did was we had a stablecoin yield fund. There's a lot of different great ways to generate yield on chain. Doing that yourself can be, it can be very dangerous, but it can also be a big hassle. Let's say you are an expert and you're good at avoiding exploits and things like that. You still have to be always monitoring yields and opportunities and moving your assets. And I have a good friend who is, works in a different field, is smart and understands DeFi well. And in the 2021 era was doing a lot of yield generation on stables and ETH. And I talked to him a couple of years later and he's like, yeah, I just kind of gave up on it because it's too much time and effort. To keep finding, okay, this yield generating strategy used to be good, it no longer is. Athena was obviously an early mover, and Avant is one of the bigger Athena users in the world. We love Athena. We run carry trade too, but we also run Athena-based strategies and others. But they were a big early mover in like, hey, let's tokenize some of these crypto native yield generating strategies that are dollar neutral. And they've had incredible success. The Sky / MakerDAO ecosystem, they have a different source of like really strong yields too. So if you look at like staked USDS or you look at USDE, both of those are really scaled with really good yield relative to their scale. Both are in like the mid single digit billions with really solid yield. The goal of Avant has been to just provide high quality, entirely DeFi based yield that's highly transparent. Some of these players like Stream who blew up were running a lot of off-chain strategies and they did not have good proof of reserves. And right before their blow up, they're like, hey, proof of reserves coming in 12 hours. And then the 12 hours came, they're like, give us a few more hours. And then it never came. And so it's kind of like you need to have good proof of reserves from day one or have everything on chain. So we have everything on chain. All our wallets are transparent. You can see all of our strategies in real time. But then we kind of do the work for you where you don't have to be monitoring and adjusting strategies, et cetera. To some extent, I was building something that I wanted to use. To that earlier point of like the 2021 era, I did a lot of kind of on-chain yield generating stuff as well. And I felt and saw a lot of that, like, if you're not doing this full time, you're going to burn out of, yield seeking. So being able to just mint and stake and chill and then have, someone doing this as a full-time job, like optimizing that yield is like a pretty big deal, I think. It's something that I wanted. I think I mentioned earlier, like sometimes I end up just building things that I want to use myself. So that's a little bit of kind of why we built that. And yeah, I don't know if I would say we were that early. I think everyone's been wanting yield on their stablecoins since like stablecoins have existed, but getting it took a little while. And so that's a little bit of the history there.
So what's the differentiation? What is Maker's source of yield, and then what's Avant's source of yield?
Maker's source of yield is kind of multiple sources. So there's people borrowing against ETH, Bitcoin, etc. But then also they sit on a massive USDC treasury that they lend out, so there's like Spark, which is in the Maker ecosystem, is like making that treasury productive. So they're lending those assets on Sparkland and on Morpho and now
I think I can speak to this too.
Yeah, you should speak to it better than me.
So
yeah,
the Sky model has shifted away from originally it was you went to Sky, you locked up your ETH, you borrowed some DAI, right, and that was the business. The new model that Sky kind of pioneered, and frankly, Aave is now kind of following suit because they see that this model works quite well, is that you basically spin up pods, right? You can think of them as like prop trading arms, right? And so you have a Spark, you have a Grove, you have a Obex, you have a Keel, and they're basically allowed to allocate credit into, USDS credit into various things. So Spark, for example, right, they have their own, lending protocol, right? So they will seed, USDS liquidity into their lending protocol, right? And now they become, right, the front end for, okay, you go to Spark, you lock up your ETH, your wrapped staked ETH, whatever, right? And you can borrow USDS against that. Grove takes a different approach, right? Grove is basically just allocating into tokenized assets primarily. And while Spark does do some of this, right, it's primarily Grove right now who is kind of at the forefront of this with the lion's share of the credit available. And so what happens is essentially, right, let's say Grove wants to allocate 500 million into BUIDL, right? Into BlackRock BUIDL. It's a tokenized money market fund, right? They're going to go and earn 3.5% on this for the protocol, right? What they do is they mint some DAI, right, out of poof, right, essentially like a flash loan. You go to the peg stability module, which is basically what maintains the USDS peg to $1. And there's there's billions of USDC in there. And so you swap the USDS into USDC, you liquidate the USDC into dollars, and now you can go to BlackRock, right, and buy these BUIDL tokens, right? This tokenized money market fund, right? And so now you go back and you essentially have the BUIDL tokens, right, backing the USDS that was like originally minted, right? So it's almost like a flash loan in that respect. Yeah, you have OBEX kind of doing similar things to Grove, right? Allocating into various like tokenized assets. But typically, I think Sky plays it relatively safe, right? Like predominantly, this is just money market fund exposure, right? Like BUIDL, USTB from Superstate, centrifuges, JTRSY, right? There are some CLO products mixed in there, right? So CLO are credit loan obligations, right? So these are a little bit higher yielding products, right? They're essentially a fund of different bonds, right? So you have like Janus Henderson issued through Centrifuge JAAA. You have Apollo, who's issued through Centrifuge Accredix. I think Galaxy is issued a CLO.
On Avalanche, yeah.
Yeah. Right. There's a Securitize through Stack issued their own CLO, right? So what you're kind of noticing, right, is that there, as kind of treasury bill rates are coming down, right, and as there's kind of this expectation of monetary policy easing, that all that money that was allocated into treasury bills, right, is looking for higher yielding opportunities because people over the past few years just got very enchanted with their 5% yields, right? And so these CLO products, right, are kind of a step farther out, like less liquid than treasuries, but higher yielding than treasuries, right? And then on the extreme end of that, right, you have kind of pure private credit products, right? So that are, even less liquid than the CLO products, right? But again, even higher yielding than the CLO products, right? So you have this scaling curve, right? And the role of Grove, right, but the role of Sky, right, is just to manage their exposure, right, to these various different permutations of tokenized assets.
So almost very familiar with the like risk creator model with the like Morpho and kind
exactly.
of so it's
almost exactly like that.
Yeah, almost exactly, except their mandates are more flexible, or rather the yield instruments they can use are more flexible. It's not just markets on Morpho. It can be anything that I assume goes, you have to like to be added as a cluster, as a Spark. You have to be go through some governance process, DD,
I mean, they also put up junior capital, right? To be clear, right?
Well, so I guess that makes sense.
This is not unbacked lending.
Yeah, that's what, because you made the flash loan comparison, but in a flash loan within the same block, the collateral was being repaid. So where's that happening here? I guess how does that work? Because from what I understand, they're allocating basically lines of credit. You redeem some USDC and to go into a yield instrument. Then let's say it goes in the BUIDL fund, but then the USDC has to sit in the BUIDL fund, right? Or the USD has to sit in the BUIDL fund.
I mean, to an extent, since they've put up junior capital, right, there's a certain amount of risk that, like credit, that you can extend them, right, with low risk.
Okay, like, junior capital meaning like they have collateral staked in with. Yep. Okay, got it.
Exactly.
Got it. Okay, that makes sense. And then each team, so they have to come to the table with their own junior capital that they probably fundraise from somehow, plus an idea or a mandate, rather. Like, exactly. Here's what's going to go, and then, okay, got it. That makes sense. And then this all... Mm-hmm.
Yeah, like the way to think about it is that they're essentially competing against each other, right? So rather than you having, potential stagnation in an org as kind of like, the OGs or, the old guard kind of just like settles in and gets comfy, you have this constant, right, competitive element
churn of new teams with new yield ideas that as crypto expands and more tokenized equities come into play, tokenized loan originations come into play.
Exactly. It should be noted, right? They're not competing to see who can provide the highest yield. It is on a risk-adjusted basis, right? Who can provide the best risk-adjusted yield? That's their performance metric, right? And if they credibly prove over time, right, that they have, the best risk-adjusted yield, right, then they get more credit allocated to that particular SubDAO, right? It's a very continuous and, fully feedback loop type of mechanism.
And the Maker token serves as the governance for all this? Like, is this all run decentralized maxi?
Well, it's the Sky token.
Sky token, sorry, yeah. Okay.
Which used to be the Maker token.
Which used to be the Maker token, yes, right, and the USDS, which used to be the DAI token. It's just a rename.
The SubDAOs, I think, is pretty smart. Rune had a good conversation a few years back, kind of saying that he was concerned that like DAOs might be dead, and he's like, okay, it's probably going to work better if you have kind of these SubDAOs with some competition and some different mandates and things like that. So I think there's beyond kind of the approach to yield and things like that, which is also intelligent. To me, it seems like a good approach to governance, because having it all just contained in MakerDAO seemed like that was maybe just not going to work well from like an organizational perspective.
Absolutely. Like DAOs are. I have some choice thoughts on DAOs, but I think they should be as narrow as possible. You cannot have everything be universally like governed by like a community. There's no way for anyone to even stay in the loop and up to date on every element, right? You need to silo these functions, right? And you need to have kind of experts in each of those silos, right? That are kind of administrating independently.
Yeah. I mean, you saw Stanley even recently. He was talking, the whole Aave V4 upgrade was interesting to watch it fold. And I think was a signal to the broader industry around, okay, if something about governance does need to change now. Sky was probably, they just had the foresight, like Rhett mentioned, Rune kind of saw this as is, but even in my own work with DAOs, I found that governance is just a pain. Communicating with people, getting people to read everything that you actually wrote and actually want to do is a pain. The funding process takes a very, very long time. And there's no like a Darwinian competition, to your point. You don't have a survival of the fittest kind of pod model. So I just want to add that makes a ton of sense.
I've never left working with a DAO in some way, shape, or form thinking to myself, yes, I should have some of these concepts, implement them in my own company. It's always been a cautionary tale.
It's not that bad. I think you're being a bit.
Everyone that I've worked with, the Sky ecosystem seems a lot better. But they have created these clusters, and there is a very strict mandate, right? There's a visionary who said, here is how everything is going to work. So now there's a framework that everyone plays inside. But no, I honestly can't think of a single DAO that I've worked with where I'm like, yeah, that was great. I would definitely recommend working with them again.
I think Robert Leshner put it pretty well. So he's founder of Compound and Superstate, and he was kind of saying, probably avoid DAOifying until the product is really mature, because you need kind of like a tighter team building the product. And then at the point you do DAOify, ideally keep it like what they're governing, like relatively contained. So I think that's a pretty good way to approach things, or splitting into these smaller DAOs with like really limited scope, I think is another smart way to approach it. But yeah, DAOs, I don't know. Yeah, they're interesting. There's pros and cons, but I think the Sky MakerDAO kind of ecosystems, approaching it in a smart way. The liquidity approach is like completely different, which I think is also smart, which is they only build ungoverned systems. So they only build immutable systems that never need governance at all. So I think that's also a smart way to do it.
So as we talk about DAOs, and then my mind goes to DeFi. In this world that's changing, I think, are more people going to be creating DAOs or not? It feels like that market is relatively flat. But in terms of DeFi primitives, how do you guys think DeFi primitives are going to be used? Are they going to be used in new ways? Do we need new primitives? Do we just need more robust current primitives? But as this wave of tokenization starts coming in and TradFi starts coming in, what do you think happens to these OG kind of like DeFi models?
I understand why people think that like innovation and some new primitive is like the next unlock, right? That gets us to the next, order of magnitude of scale. And I get why people think that. But we've already built like primitives that are going to get us to at least like 2 more orders of magnitude in size. Like technology and even products are not the bottleneck right now. It's really everything else, right? And so it's surprising to me that like sentiment is so down, right? Or I guess not, because I guess a number goes down, people are sad. But from like a metrics point of view, like everything is going incredibly well. I hate to beat a dead horse here, but like tokenized assets really are the unlock, right? And we look at institutions like BlackRock, right, and we say, okay, BUIDL is I don't know, what is it now, $2.5 billion in size. And we're like, oh, that's big. Like, no, for the institutions, that's nothing. Especially for BlackRock, the largest asset manager in the world, right? That's just like a tester. So, these institutions are still working through getting comfortable, right? On creating these products. What is all of the compliance stuff that goes behind there. But even right in, okay, now we've deployed this token. Okay, we're still missing like a few key pieces that let these tokenized assets like integrate natively into DeFi, right? Like you may have heard recently like, oh, we have like credit looping, right? And on the surface, it sounds amazing, right? You have a tokenized asset that's maybe yielding 7%, and you can borrow capital on Aave right now, I think at like 3%, right? And so on each loop, you're making 4%, right? So you can go and do like 5x leverage, right? And you're making like, I think it's like 27% APY, right? And you're like, this sounds like financial alchemy, right? This is broken, right? And yes, it is kind of broken because it's very easy for you to create the position by looping into it. It is almost impossible for you to get out of the position. And that's what's kind of needed right now as the next unlock is the redemption process of how do you go back from the tokenized asset into cash or into, whatever the thing is that you are, the quote that you are borrowing in, so you can unwind that position kind of like in one go. Right now, right, most of the tokenized asset redemption process is, you are literally going through the TradFi rails of, okay, here is this tokenized asset. Okay, burn it and then go send me the cash on like a delayed basis, especially if it's not T-bills, in the best case, right, you have redemption windows of 1 week. In the worst case, could be like once a month, once a quarter, right? And now you go and trade your dollars back into the stablecoin that you borrowed, right, to create this levered position. And now you can finally pay back some of, not all of, right, but some of that position. And now you can do it all over again, right? That is still fundamentally broken, right? That is not going anywhere, right? It serves like a really cool on the surface thing of like, yeah, we have this tokenized asset. It's in Morpho. We're looping it. We're getting crazy APY, right? And then the magic kind of stops, right? So I think the next big unlock is going to be when you can do on-chain atomic like redemptions, because that's when tokenized assets go from like this esoteric, thing that doesn't fit into our DeFi protocols kind of like
inside the smart contract bubbles,
and they start becoming composable, right? Like if anything, that's like the word, right? Off, on-chain, atomic redemptions are going to enable composability. And if we can do that, we're set, right? And that doesn't require really anything built on the on-chain side, right? This is really just like on the institutional side, right? On the TradFi side, right? Building up these redemption capabilities, because that's really what's holding back product market fit.
I think there's a lot of truth to that. On the whole, I think that, almost all the primitives you need are there. They'll mature. So lending and borrowing is something you want to need. That's like in a decent spot and improving all the time. Perps is like a super important area of crypto. Derivatives in general, there's options as well, but perps is the one that's gotten a lot more adoption. And it's kind of nuts if you look at the revenue of Hyperliquid. It's like in some periods they're generating more revenue than the rest of crypto combined. And it's pretty awesome, in fact, to watch last weekend. There was some crazy speculation on oil markets, and a lot of traditional markets were closed, and so people were using perps for that. And in a few cases over the weekend, I was seeing you could get paid like 5,000% APR to be long oil on Hype or Lighter and some of the others. So like the key derivatives are there, lending and borrowing's there, DEXs are there. I agree with the points of Nicholas about what's going to improve composability of RWAs, but we have RWAs now. So to me, it's like those improvements, and then just significantly increasing like on-chain liquidity and adoption, more so than like, hey, here's a primitive that we need that we don't have. A few years ago, before we had any like derivatives exchanges that really worked well, that was the one piece that I kind of felt like was missing. And people have known that for a long time. Like there's been attempts at on-chain derivatives for several years now, but like none really functioned well enough until more recently. So I can't really think of anything that's like, man, there's this primitive we really need, we don't have. It's more about improving the ones we have, and then increasing on-chain like liquidity and adoption and those things.
Yeah, it seems like to summarize, the largest step forward would be to increase liquidity profiles for the tokenized assets that are living on-chain. And I agree with you guys. I don't think that means building new smart contract primitives. The only models that I've seen work, and the world is still very young in this aspect, but so maybe it'll change over time. But the only thing that I've really seen work really well is actually the Figure model. So he was working Figure, HLOC, loan originations. They have their own loan lending business for home equities. Then they tokenize, since they're originating the loan. They also just tokenize it. It's a lot easier that way. And then they host a secondary market on chain. But the way he created liquidity for these tokenized home equities is they partnered with a hedge fund who pulled a $200 million line of credit. And so then every single month they've got $200 million just to purchase these home loan bundles from on-chain. And then they just turn around and flip it right back into the TradFi financial instruments that already exist, with all the partners that they already know and everyone else who's already buying these home loan equities and this specific profile of home loan equities. And so I thought that was actually rather clever and very interesting, where they would scale up the strategy and basically find a TradFi partner who is just crypto savvy enough to believe in the thesis, but really what they care about is, oh great, I am getting maybe not preferential treatment, but I have a very competitive way to find home loan equities that then I can just flip, which is already a big line of business for them, is like finding little arbitrages. And what that creates is now his market is, I think, still the most liquid market for any tokenized asset. And so if you look at his on-chain markets, they're just like churning constantly in a good way. So I thought that was rather impressive. Of course, they just IPO'd off that model, and the model seems to be working. Now they're going to try to scale it up even more. So we'll see how that story progresses. But that skill set to be able to create these kind of liquidity instruments, let's call it, but it's got a new type of DNA to it. It's not pure DeFi anymore, right? It's how can you plug into what exists today?
Yeah, so one of the interesting things, you introduced me to Jim Hiltner from Superstate, Stephen, that he and Thomas Cowan from Galaxy mentioned was that we said that tokenization was going to provide liquidity to the most illiquid assets. And that was kind of where the huge unlock was. I think Figure was the exception rather than the rule in that case, because if you look at maybe probably commodities, gold, whatnot, they're pretty large overall. You have tokenized equities, another super liquid market. Prior to that, I mean, the biggest ones last year were private credit and treasury bills, which are basically dollar-denominated assets, which basically Thomas pointed out, the two most liquid markets are basically treasury bills and just dollars themselves. So that was an interesting point. Now, what role does it play, like primitives play in the future? I mean, it'd be awesome to lever up on some of these assets, like these traditional finance assets as a degen, sure. Now, is that really like the way it's going to play out? I don't really think so. These permissioned types of models and assets, I don't think will live in the same space that meme coins do, per se, just because it's a completely different demographic. There's completely unique characteristics to what these things do and how they behave, and also the willingness for people to touch them is highly different. So maybe what I want versus what ends up playing out are two completely different things, but I've already come to terms with that a long time ago, for better or for worse.
Yeah, even in the Figure model, to participate in their marketplace, you've got to go through a KYC process, pretty above board. I think I was talking to one of my buddies, venture capitalist. He treated Figure as like, okay, this is the regulated above board approach. So he seems to think that there's plenty of space for people to still innovate around on the more decentralized protocol, kind of anonymous maxi, almost like a hyperliquid, like the hyperliquid segment of that market, where it just lives on chain, anyone can show up, no KYC, and start playing around with it. But I'm sort of with you, Kelvin. Sort of like I'm not so sure that, let's say like student loans is next. I want to leverage up on these student loans. It's It's like,
how about this? I'm happy
know.
for the market to prove me wrong. That being said, it's going to do what it's going to do, but very skeptical at this point in time. I feel like we probably would have already seen it if that was the case, given just the Cambrian explosion of all these new protocols and people building on top of just like Hyperliquid, for example, or all these traditional finance institutions that have expressed interest and are actively coming on chain as is. So, yeah.
I think you would be surprised, right? Like we almost like lucked our way into tokenized asset growth in like a very weird way. You may remember, like, I think it was, I would say like back in like 2023, Maker kind of got a reputation for rather negative, I would say, of being like wrapped USDC. Because essentially what had happened is that as kind of ETH, which was, the primary, and BTC, which were the primary collaterals in the system, as they were crashing, right? All of the people who were margined up on, Sky basically got liquidated, right? And what would happen is that as DAI supply disappeared from the market, right, to be able to, because it was being bought up to participate in these liquidations, that pushed the DAI price up, right? So DAI was like basically permanently like, always having like positive pricing pressure above $1. And this is when this peg stability module that I mentioned earlier, right, kicked in the sense that anyone could, supply the PSM with the USDC. The USDC would mint them the PSM would mint them a fresh DAI, and they could now go and sell that DAI, right, for more than $1 on the market, right, and arbitrage that spread. And so what essentially happened is that like Maker's book went from being like, 90% dominated by, ETH and BTC, to actually the ETH and BTC being like a very small portion of the book, and it just being some crazy number. I think like, don't quote me on the exact number. I want to say it was like $10 billion of USDC. Like Sky was the biggest holder of USDC by far, right? And so people, the narrative was kind of like, why would you use, DAI when you can just use DAI is just backed by USDC, so just use USDC. Well, I think that ended up like actually being like Maker's superpower, because what ended up happening with the onboarding of tokenized assets was that, well, Maker can't go and buy a BUIDL token with DAI. BlackRock doesn't accept DAI. BlackRock accepts US dollars. But Maker had this 10 billion USDC, right, that it could take its DAI, swap it into USDC, and redeem the USDC for dollars. So essentially, right, reallocating its book, right? And this is a key distinction, right? Because normally, like Maker was in the lending business, right? You locked up your ETH as collateral. Maker lent you, DAI, and Maker wouldn't touch your collateral, right? It couldn't say, we're going to use your ETH and go buy some treasuries with it, right? But we still owe you an ETH. No. But the USDC that Maker had accumulated through the peg stability module was different, because that was a swap, right? It was not a loan. You were not locking up your USDC and borrowing a DAI. You were just swapping them. And so that USDC was protocol owned. And so that was like the intro to Maker being able to like reallocate, right? And so that was actually the opportunity where, usually all of the DeFi protocols like Aave and Maker, right, had revenue that was highly correlated with, is it bull time or bear time in crypto markets? During bull time, everybody wants leverage, everyone's borrowing, interest rates are high. Maker and Aave make a ton of money. But during the bear market, when everything's crashing, nobody wants leverage, nobody wants to take out loans. They're closing existing loans. Interest rates drop. And so there was this like hyper cyclical, right, like boom bust on their revenue, right? And so this huge stash of like USDC that Maker had, right, was like the fuel that they were able to utilize to, diversify their revenue to like get rid of like this boom bust kind of like characteristic and like really like smooth it out, right? Would tokenized assets like be at the size they are at today if there wasn't a Maker with $10 billion, to like spray into them, right? Which, almost like became like a self-fulfilling prophecy, because Maker like had this money, because Maker was, willing to allocate it, right? That was actually the impetus for a lot of these tokenized products to even be released, right? And so there's just going to be, weird little quirky unlocks like that, right? That just you wouldn't necessarily suspect, right? But they just let, both DeFi and let tokenized assets just level up like to the next stage. Like we haven't seen that with tokenized equities yet. But I think there's going to be a catalyst at some point this year.
I kind of think that just having the ability to trade equities 24/7, just that is going to cause a massive like on-chain flood. If there's not enough liquidity for truly wrapped equities, people would just do it on perps. It's like yeah, my thought is just that is such a big deal that that the equities are going to all be on chain relatively soon, because if you're not trading on chain, you're going to miss significant opportunity.
I love that. And I was maybe this preempted my question, but I was going to ask you, Nicholas, if we don't know what the specific catalyst is, what do you think the catalyst would look like? What do you think the shape of that would look like?
Like the shape of the growth? I mean,
of the catalyst. Like, what would that catalyst look like?
I mean, if I knew, like, I would probably be trying to secure it. I think there's still like a few problems. Right there's various different implementations right now. I think the implementation that should win is the one that's actually backed by a real equity, right? In a very straightforward manner, and that's not, hidden away in some kind of, SPV like that.
Of an SPV that's in the Cayman, but
like
also
an
the
SPV
Seychelles.
that like has a liability of like it owes you, right? An equity, right? If you come to it.
Right.
But if the SPV declares bankruptcy, right, then like, it doesn't have anything to give you, right? So there's still, I don't want to call anyone out, right? There's still a couple models that are quite flawed. There are a couple models that are actually doing it the right way. So I'm hopeful that those take off, but the question is also like liquidity, right? Market making across, the top 500 stocks is incredibly capital intensive and the cost of capital is incredibly high, right? Like, if you ask like a market maker on like, how much like they're yielding on every dollar, it's probably like around like 30%. So you have to go and like compensate, like if you want them to go and make markets on each of these like 500 like largest stocks, you have to go and compensate them, right, for, seeding that liquidity, and you better be beating or meeting 30%, right? And that bootstrap is just, I don't think it's like feasible for anyone right now, with the level of like magnitude of capital. So maybe the big unlock is going to be that like SoftBank comes in and just like gives someone like $3 billion,
Just
something crazy,
bet.
right?
Or
and
the sky. Why not?
You never know.
Sorry, I like that. I like that answer.
Something you said made me think of the Denari team, because I think they're one of the teams who are doing it more one for one, doing it the right way, and they're also on Avalanche, and that got me thinking. I know both of you very, very entrepreneurial, so I'm curious, taking the conversation in a slightly new direction, what kind of advice would you give to somebody as let's call both of you guys second time founders? I feel like you guys are at least that entrepreneurial. So what kind of advice would you give somebody who's thinking about starting a new DeFi protocol today?
I don't know if it's DeFi specific. I'm just going to say like, it's a roller coaster ride of emotions, right? Like 1 week you feel like you're just dominating and king of the world. And then like the very next week, you're just like, oh, it's all over. Like, it's cooked. Right. And, you just learn to kind of like self-reflect, right? That neither of those things are ever true, right? And you kind of like I don't know if numb is the right word, but you're just going to compete. You repeatedly go through this like roller coaster ride, and like your job is like just never to give into like any emotions, right? And always just stay very, very like almost like you're observing yourself, right? And you're observing like the present situation so you can make the best chess move. If you're not able to control your emotions, right? Like you're going to burn out, right? This is founding is a sustainability game. Your goal is to survive. Like that's the mindset that you should have.
Yeah, my thought is like, action compounds, for one. And, if you do wake up in the morning and feel like you're, on the verge of death as a project or whatever, the best way to deal with that is just say, these are the actions I can take today to improve the situation. Bill Ackman talked about this a little bit when his, I guess he was getting divorced right as his fund was about to blow up, et cetera. And he recovered in a great way. And he was just basically like, hey, every day I'm just going to see like I can make a little bit of progress on these things every day. So I think action is a big thing. I also think like trust and relationships compound. Crypto is one of those interesting industries where you have a lot of really awesome builders, and then you have some that aren't. And those that aren't will wash out periodically. And so if you're just demonstrating high ethics and surviving, to Nicholas' point, those things like have really significant dividends over the course of years. And so maybe not a lot of dividends over a 6-month time horizon, but over a 2, 3, 4 year time horizon, really significant. So I think that's a really big deal in this space, probably even more so than most places where you could be a founder.
So Steven, I need you to answer your own question, man. You're a DeFi founder. It's not the second time, but still DeFi founder. What advice do you have?
Man, theirs was actually really good. Nicholas, yours is, as I was thinking of how to phrase the question, I just had another parallel process of how might I answer it. And that's pretty close to what I was thinking. Is like, you got to be really good at making high quality decisions while the house is burning. The only way to do that is you have to be detached. That's the word that I use. Not numb, but for me, it's a form of detachment from like, okay, yeah, there's these roller coasters, highs and lows. I remember for me, there was a period of 18 months, 18 straight fucking months where every month was the highs of the high, next month was the lowest of the low. So 18 months in a fucking row. Like, can you imagine, like, what other job or occupation does that happen to? Like it's a very, very unique human experience. And yeah, you've got to be extremely good at not letting it you got to be able to keep your fight or flight instincts basically turned off. Cause as soon as that turns on, you start blacking out. You're like, you just start making rash decisions that, especially when I feel like for all of us here, like you're literally competing. I had a good friend of mine once tell me at the lowest of my lows, like, dude, like any new founder, even in Web2, even AI founders would love to trade spots with you because just where you're at in the ecosystem, who you're competing against, what the stakes are. I mean, that is literally what every new founder trying to go to Y Combinator right now is even just dreaming that they can survive long enough and have the type of relationships that they can compete at the highest level. I think about that pretty often. It's definitely extremely unique.
Yeah, well said. And I guess to follow up to Steven's question, maybe for you, Rhett, specifically, I was listening to one of the interviews where you said that Ava Labs and the foundation were very nice to you, which is why you decided to deploy first on Avalanche, nice. Even though you are chain agnostic. But I kind of want to dig a little bit deeper because that didn't seem like the full story. So what were they helping you out with that made it so like such a compelling case?
Trying to remember where I said that, but I have said that several times. But I was trying to remember where I said that on an interview. Look, I think, Avant doesn't have much of a habit of like. By the way, I'm not criticizing anyone who does, but we don't tend to like go ask for like grants and things like that. And we never asked Avalanche for a grant, and did not receive one. We didn't ask for one. Maybe they would have given us one. They were early supporters in a few ways of us. There wasn't an asset like ours on the C chain, and so I think they wanted to attract something like what we're building. They did a few things. So there's some positive signal. Some early AVUSD was minted by their foundation. Not a ton relative to our size, like maybe a few $million, but that's good early signal. So that was helpful. So we're at maybe 135 mil in TVL, and of that, a few mil from them. So that's helpful. There were some incentives they threw at some liquidity pools of ours without us asking, which was really nice. And then they were just an advocate for us. So they did a DeFi push that was, I thought, really well executed. It got a little bit wrecked by the stream blow up, as lots of things did. But they attracted Euler and some other platforms over and had kind of an incentives campaign, etc. Those didn't go directly at Avant, but they indirectly, substantially were helpful to Avant because they were incentivizing like stablecoin lending, and Avant users love to borrow against staked AVUSD, and so that was really beneficial. And they were just really good at like taking good feedback. As they were launching that program, I said to them as they were launching the program, hey, no need to incentivize like staked AVUSD. I'd incentivize lenders instead. We can bring borrow demand as can others. So, and that's the approach they went with, and it was great. Really competent team. I thought their DeFi initiatives have been really positive, and yeah, I've been happy with them. I loved Eric, who's no longer with us, but Matt on the DeFi side is excellent. Matthias on the foundation side, excellent. I just think, yeah, those are the people we've interfaced with more, and they've just been awesome, like really, really good to work with. So I don't know if that adds a little bit of color for you, but yeah, they're a really good, friendly team. And speaking of like people who are like, as I was mentioning earlier, like, you know, honest founders and people who like just engage in a good professional way, they're like top of the list there.
Yeah, good call on the borrow demand side of things, because that's virtually infinite when it comes to lending in crypto. At least I've noticed. So nice.
I was just going to say a quick clarification note for the listener. Eric King is alive and well. He's just happened to move on from Avalanche. He's working on a different opportunity.
Sorry, he's no longer with AVAX. I didn't mean to put it that way.
Nah, we're leaving that in.
Oh, man. So, Nicholas, I was curious also, because I forgot to ask you this over this several times that we've hung out, whatnot. Like, what did you experience during Black Monday? Like, were you still at Maker at that time? And like, sorry, not to reinduce a migraine for you, but like
PTSD.
What strength, like what do you have to work through, like at that time?
I'm sorry I must be showing my age in crypto a bit, because like we have a Black every day of the week at this point. Like I think the like Black Thursday, right, was like May of 2020, right, like preceding DeFi summer. Right.
Oh, and that's what it was. Yeah, Maker had that massive drawdown.
Crash from like, you know, I think it was like $400 down to like $80 or even like $60 or something like that. And we had just closed like a fundraising round, right? And like some of those funds had put in the largest check that they had ever written, right? So they were, you could say, overweight in MKR. And then literally like Black Thursday happened like the week after. And there was a not like a code exploit, but someone managed to basically just like break one of the assumptions of the system, and that they just triggered a ton of auctions, like liquidation auctions at the same time, and bid like one GUI. And, those auctions had like a timer on them, and the chain was so congested, right? You could not get a transaction to go through. So, we were desperately trying to like bid on these auctions just to even get them to continue. Like if you did another bid, then like there would be like a timer reset, and the auction would like continue more. Right. So it didn't even matter, like, did you bid like a fair price or not? Like just bid something. But in the end, I think like Maker ended up having like a $10 million hole in its balance sheet. So basically Maker wasn't solvent, and like had to go to the VCs and be like, hey, you guys want to, put good money after bad? Right? Like you were already overweight in MKR, right? But like this thing is going to go to zero, right, if you don't recapitalize this right now. And so thankfully, right, Paradigm stepped in. But that was a very, very formative moment. I'd say the only other one that came close was when Silicon Valley Bank, right,
Oh, that was a scary
one. We had the USDC depeg, and DAI was essentially pegged to USDC because of this PSM I talked about earlier, right? So if USDC drops to 80 cents, guess what? Everyone's buying USDC for 80 cents, sticking it in the PSM and pulling out a DAI, right? DAI's trading at $1. Nope. DAI gets arbitraged down to whatever USDC is trading at. And so, yeah, that could have also spelled the end, right? If USDC never repegged. So
it helped inject a lot of capital into MakerDAO, though. Yeah.
Oh yeah. Yeah, definitely.
I actually, at the time, I wasn't that worried about USDC blowing up. Maybe I, was under assessing the risk, but I thought the risk was low, and so I was like, oh, MakerDAO is a big winner here. I honestly thought that was like a great win for Sky.
Selfishly, when that collapse happened, I think, not even worried about the crypto industry as a whole. I was at my first crypto startup after leaving right after, I believe it was FTX collapsed. And I was like, dude, how am I going to feed myself next month, dude? Like, this is insane. I thought getting in on the way down was supposed to be like easy mode. What the hell is this? We had we were like an Andreessen-backed startup. We had a decent amount of runway. I'd say more than like a year's. And basically our entire bank account just got slashed. And we were like, well, is this going to be curtains? How are we going to explain this to our investors? And I was like, dude, do I have to go back to Web 2? I really hope not. I was liking this whole crypto thing. So I got a little PTSD shared with you there, Nicholas, on that one. Definitely not as severe, though.
Yeah, I mean, in interesting moments. Some nice revenge arcs too, though, right? We had Do Kwon, saying that by my hand, DAI will die, and think like on the 1 year anniversary, I did like a little tribute post, the before and after. You come for the king, you best not miss.
Oh yeah, it wouldn't be crypto without the dunks.
I mean, that was kind of like the really disturbing part of DeFi is that like you needed to have a liquidation penalty. So you get liquidated, right? You lose some amount of money, right? And if you didn't have this liquidation penalty, then you could have a scenario where someone would just like liquidate themselves, right? And buy back their collateral at a discount, right? So there was like an actual reason that like these liquidation penalty fees like needed to exist. But at some point, like the DeFi protocols like Aave and Maker and Compound were making like 90% of their revenue from liquidation penalties, right? Not from the interest on the loans, right? And so like, you had this really disturbing kind of like the tokens were almost like the tokens were almost like anti-cyclical, right? Or like MKR was outperformed in a bear market because in a bear market, like you just had tons of liquidations and the protocol was printing, right? But it's a bit tone deaf, right? To then go on like CT and being like we're doing so well, like look how much money we made.
All right, I do have to run too, so I'll read this out. But so guys, that was lovely. We're going to probably call it here. I think that was a great conversation, super cerebral. So I want to thank you both, Nicholas and Rhett, for joining us this episode. As a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the blog. Thanks. See you next time.